And welcome to the Kudlow Report, where we believe free market capitalism is the best path to prosperity. I'm Michelle Caruso Cabrera, in tonight for Larry Kudlow. Big win for the bulls today as the September rally roars on. Positive economic data putting the Dow and the S&P on track to post their best September since 1939, even as new home sales hit their second slowest rate on record. Is the American dream now an American nightmare? We're going to talk about it later in the show. Plus, no tax certainty from Washington as the Democrats dodge and delay a vote on the Bush tax cuts. We're going to look ahead to see how punting on this is going to play out at the polls. First up, though, CNBC's Bob Pisani has the full report on the September stock rally. Bob.
It was another great day for the stock market, Michelle. In fact, September's been a great month so far. I'll get to that in a minute, but simple story here. Reflation trade in commodities. David Tepper early on saying he was going into stocks, but look what commodities did today. Up 2, 3, 4% on the day. Anything, wheat, lumber, corn, silver, oil, it didn't matter. They wanted it. As a result, we saw commodity stocks do well, particularly all the metal stocks. Mittal in the steel sector, didn't matter. BHP Billiton, Alcoa, Freeport-McMoRan all had terrific days here. How about what's going on overseas? Because emerging markets are hot. The EEM, the Emerging Market Index, 2-year high. We had the Philippines at Jakarta in Indonesia. That's an historic high for them. Korea and India also at 2-year highs. This is also fueling the international stocks as well. We had a big deal today with Petrobras successfully pricing $67 billion secondary. That was the biggest secondary, the biggest anything ever. That has fueled some hopes that maybe the IPO market would be stronger and will be stronger than expected. We priced almost 9 IPOs this week. I'll tell you what would impress me, Michelle, if you could get a good open next week for Liberty Mutual Agency. This is one of the last mutual insurance companies that's going public next week, almost $1.2 billion. If that has a great start, then you could definitely say IPOs are back. For the week, the Dow Jones Industrial Average, heck, everything was up about 2%. Michelle, here's what's more important. This is supposed to be the worst month for stocks. This S&P 500 is up almost 10% for the month. Back to you.
Yeah, contrary to popular wisdom, when people started out at the beginning of the month very bearish. Thanks to Bob Pisani. So is the return of the September rally for real? Here now to make sense of it all is Jim LeCamp. He's portfolio manager at Macro Portfolio Advisors. Michael Cugino, president and portfolio manager of the Permanent Portfolio Funds. And Peter Schiff, president of Euro Pacific Capital and author of How an Economy Grows and Why It Crashes. Guys, good to see all of you. Michael Cugino, let me start with you. Do you believe this rally, or is it a sucker's rally?
Well, stocks are still very reasonably priced based on earnings, leverage, and potential in the U.S. economy for further growth. Not only that, but there's a lot of liquidity on the sidelines that could either move in from treasuries or bonds into stocks, and other liquidity and dividend yields are favorable compared to bond yields right now. So even if you're waiting for more robust economic growth to continue to further propel stock prices, you can be paid to wait with a good dividend yield. So there's a lot of positive factors out there on a PE basis. Things look good, too.
Jim LeCamp, what were you doing today? Were you selling into this, or are you buying?
We've been buying for the last month. I don't like to buy with the tape up 200 points, so today we were just holding. But the market does look good. We set new highs today. We broke through the technical resistance on the trading range. That's a good sign. Historically, the market does very, very well leading up to the midterm elections. That's a good sign. And like Michael said, look, the Fed's taken away all other avenues to invest. So for now, we like stocks. We like particularly the emerging markets better than the U.S. But in the U.S., tech stocks are moving. Machinery stocks are moving. We're seeing a nice rally here, and I think it plays out.
Let me guess, Peter Schiff, you disagree.
Well, you know, there's no doubt that stock prices are rising, but it's an inflationary illusion created by the Fed. It's not that stocks are gaining value, but the money that we're measuring them in, the dollar, is losing value. The dollar index has now dropped by 11% in the last 3 months. I think it's going to fall a lot more between now and the end of the year and do even worse next year. So, yes, people are buying stocks to get rid of their dollars, but they're not wealthier. They're just not as poor as they would have been if they stayed in cash.
Point taken, but so somebody's watching at home. I think, oh, okay, I hear all that, but at the end of the month, they're going to get the statement, and it's going to look better.
That's part of the illusion. Inflation makes everybody feel better because it makes prices rise. But in the long run, you know, it's like it's a party, you get a bad hangover. You know, that's what the Fed is trying to do. They think by creating inflation, they're going to create jobs, but it's not going to happen.
But you haven't said what the downside is. If they're creating inflation, even as those stock prices rise, maybe they don't necessarily cover their cost of living, et cetera, because everything's getting more expensive. Is that the idea?
Sure. And of course, if you invest outside the United States, if you look at foreign stock markets, prices there are rising much faster than they are here.
Jim LeCamp, that would speak to what you say about investing outside the United States.
Yeah, we've been in the emerging markets all year. Not only have they led on a year-to-date basis, but they've led since the July lows. And Peter's right. A lot of this is artificially induced. I mean, we have a fiat currency money printing system, but the fact is that inflation is not hitting us every day right now. Oil and gas prices have remained fairly low, and consumers are seeing stock prices rise. That being said, we like the commodities quite a bit because of all the currency destruction going around in the world, and we really like the emerging markets better as an equity play.
Look at the CRB.
Investors are going to find more resilient portfolios that way, the base metals as well.
Yeah, the CRB is a good point. Michael Cugino, will you give any faith to the U.S. stock market here?
Well, yeah, I mean, I like it a lot, and we play the global growth story through U.S. stocks because it takes the currency issues out of the equation. So I would agree with those comments. And I think also I hear a case being made for diversification among asset classes. So while stocks look good on a relative near-term basis, potentially better in the long term if we have more robust growth and better fiscal and monetary policy. There's an argument for diversification to hedge against inflation as well.
That's a big if. But Michael Cugino, give some advice. If you want to play overseas growth but do it through the U.S. so you avoid the currency risk, give me some examples. How do you do that?
We like the energy and commodities names. We like financial services. They haven't participated in the growth story as much as other sectors. U.S. industrials and heavy machinery, technology as well. So there's a lot of areas I think we like going forward.
Peter Schiff, I know you like gold, but don't talk about it yet because that's the next segment. What else do you like?
Well, I agree with some of those recommendations. If you're going to buy U.S. stocks, buy the exporters, buy the commodity-based stocks. Don't buy the financials. Don't buy anything related to the U.S. consumer. Don't mistake rising stock prices for improvements in the U.S. economy. The U.S. economy is not improving. The fundamentals are deteriorating. Stock prices are only rising because of inflation. And if you're going to buy stocks as an inflation hedge, buy the stocks that have earnings coming in from abroad, or better yet, buy foreign stocks where all their earnings are coming from abroad. You get a much better hedge.
Would any one of you like to rationalize for me why it is that somebody is willing to lend their money to the U.S. government for only 2.6% interest? Are any of you doing that?
I'm not. Are you?
No.
I don't know
unless
anybody.
you believe in deflation, right?
Well, that's why stocks are rising. That's why stocks are rising right now, Michelle. But the fact of the matter is we have a lot of issues that we still face in the United States, and we're set for the biggest tax increases, the biggest set of tax increases in our history starting in January.
But are you making the case for deflation? You're making the case for deflation, right? You're making the case for a weak economy.
But that doesn't mean deflation.
Well, look,
actually, it means more inflation
first, and then hyperinflation afterwards. They're not mutually exclusive. One usually begets the other. And the notion that the Fed can act perfectly in sync and time our way out of this is a joke. They've been behind the curve the whole way.
Yeah, absolutely. Historically, the greatest inflations come when economies are weak, not strong. When you have a strong economy producing more goods, that keeps prices down. When you have a weak economy where we're not producing and the Fed is stimulating like crazy to try to generate growth, all we're going to get is runaway inflation. We're going to have stagflation like the 70s, only this is going to be an inflationary depression.
Oh, geez. Michael Cugino, what, though, if somebody is looking for safety, they don't like stocks? Look, treasuries, if we start to see interest rates rise, aren't going to turn out to be safe either. How do you get yield here?
Well, I mean, although on the shorter end of the curve, you'll be able to play the rise in interest rates quicker. Your question on is anybody buying treasuries? Yeah, we are. I mean, we're trying to manage the yield curve right now as part of our investment strategy on the theory that potentially this inflationary story is wrong and we have a double dip bounce around stagflationary situation and inflation's years down the road. And so I think some money has been made in bonds this year and may continue to be for a while because for the most part, treasuries have been in a trading range.
Right.
The other thing on U.S. Treasuries, would anybody buy them? Well, where else are you going to go? I mean, it's the best of a race to the bottom in terms of major currencies, and so to provide some
better not be in them when it turns.
But
the dollar's going to win that race.
You better not be in them when it turns, because when it turns, those rates are going to skyrocket.
Yeah,
I mean, look at how fast.
But you're missing his point. You're missing his point. I think your point you're making, Michael, is just in case we end up with deflation. Some people say there is a possibility of that. You have some money there because then that trade pays off.
Yeah, we can also be hit by a meteor.
That's exactly right, Michelle. And again, what I'm hearing is the case for broad diversification in this discussion right now.
Peter, I heard a funny snide comment there. What was it?
Well, I said, we could be hit by a meteor too, but I'm not going to prepare for that. we need deflation. Unfortunately, we're not going to get it. That would be healthy. What we're going to get is runaway inflation.
Well, we are getting deflation.
No,
wait a minute. We are getting deflation in housing
Where do you
prices.
shop?
We're getting deflation in a lot of asset classes.
But that's not
We're seeing deflation in real estate prices all over the country.
No, but that's not deflation.
We could experience.
No.
But Peter, and I agree with you on most
of that.
We could experience what Japan did. Japan had deflation for 20 years.
That's not deflation. If real estate prices are too high and they come down, that's not deflation. But you know what? The cost of owning a house is going to go up. Even though prices are coming down, utilities are going to go up. The cost of maintenance is going to go up. I mean, go to the grocery store. Are food prices falling? Go to the gas station. Where do you see consumer prices falling? They're not. They should be falling, given this huge contraction we had in the economy. But the Fed created so much inflation, prices are rising.
Suffice it to say, you don't think it's worth putting on a few percentages of your assets into treasuries for the just-in-case scenario? You don't think it's a possibility?
I would put 0%. Buying treasuries today is like buying .coms in 2000 or buying condos in Miami or Vegas in 2006. It is the sucker's trade of the decade. The only thing worse than owning U.S. dollars today is owning a promise to be paid U.S. dollars in 10 years or 30 years.
Okay.
Do not touch them.
Don't move. Guys, don't move. Quick break. Then we're going to shift gears. We're going to talk about the other huge market story of the week. It's all about gold. How high can it go? That is up next on the Kudlow Report.